Welcome back to Common Sense Investing, where we simplify investing and teach you how to make smart financial decisions that grow your wealth over time. Today, we're diving into 10 powerful lessons from legendary investors that can transform the way you approach the market. From Warren Buffett's honesty to Howard Marks' second-order thinking, these insights will give you tools to find better opportunities, reduce risk, and invest with confidence. Stick around until the end because we'll also discuss how to apply these strategies in today's markets. Warren Buffett, Honesty and Trust. Warren Buffett's success goes far beyond his investment acumen. One of the biggest lessons we can learn from him is that integrity and transparency compound over time, just like financial capital. By consistently putting the interests of shareholders and business partners above his own and being honest about mistakes, Buffett has built a reputation that attracts high-quality opportunities. A great example of this is his acquisition of Forest River, an RV manufacturer, where the deal was closed almost effortlessly because of the trust Buffett had cultivated over decades. The lesson here is that if you establish yourself as someone trustworthy and transparent in your professional and investment life, you'll attract talented people, better opportunities, and long-term advantages that competitors cannot easily replicate. Benjamin Graham, Margin of Safety. Benjamin Graham's principle of margin of safety is simple: buy assets for less than they are truly worth. However, it's important to understand that margin of safety doesn't only come from tangible assets. Intangibles like customer loyalty, strong business culture, predictable earnings, and brand value can also create a huge safety net. For instance, a fast-growing business with high customer retention and low churn might appear risky on a balance sheet, but its predictable growth creates a large margin of safety. This approach allows investors to absorb mistakes or market fluctuations without losing money. Graham's own experience holding Geico shows that sometimes flexibility in principles, combined with high conviction in the right opportunity, can create extraordinary results. The key takeaway is to look beyond numbers and assess the qualitative factors that protect your investment. Peter Lynch, Invest in What You Know. Peter Lynch popularized the idea that the best stock ideas can come from everyday life and simple observation. By paying attention to your own spending habits, where you shop, and the products your family enjoys, you can uncover valuable investment opportunities. For example, noticing a consistently busy store or a highly rated product can lead to exploring the business behind it. This method also applies to work tools, software, or services you use regularly. Observing patterns in real life helps you understand brand strength, customer loyalty, and potential growth without relying solely on complex financial analysis. Lynch's approach is all about turning personal experience and everyday observation into actionable investment insight. Philip Fisher, Alternative Research with Scuttlebutt. Philip Fisher taught investors to dig deeper and gain an edge by talking to people involved in a business, its suppliers, competitors, and even customers. This method, known as scuttlebutt, focuses on qualitative, non-financial information such as management quality, competitive advantages, and growth potential. By speaking to those with first-hand experience in a company or industry, investors can uncover insights that are not available in public reports. It's a way to identify both opportunities and risks that others might overlook. The key is understanding the incentives of your sources and triangulating information to get a complete picture. This approach can be incredibly powerful for finding hidden gems in the market. John Templeton, Fish Where Others Aren't. John Templeton was a pioneer at finding investment opportunities in places where others weren't willing to look. He invested in Japanese stocks in the 1950s when the market was largely ignored, undervalued, and volatile. Today, similar opportunities exist in underfollowed markets, like microcap stocks, where information is scarce and volatility is high. The lesson is to find areas of the market that are inefficiently priced, where competition is limited, and research can give you an advantage. By focusing on opportunities where other investors are not paying attention, you increase the potential for outsized returns while avoiding overcrowded trades. John Neff, Value Beyond Low PE. John Neff demonstrated that value investing isn't just about buying low PE stocks. He looked for undervalued assets and was flexible enough to invest in higher-priced companies if the fundamentals justified it. Comparing a low-cost, unpredictable business with a high-growth, sticky recurring revenue business highlights why some companies deserve a premium valuation. The key is to evaluate the quality, predictability, and sustainability of a business's earnings rather than blindly focusing on cheap metrics. This lesson teaches investors to broaden their definition of value to include businesses with strong growth and durable competitive advantages. Howard Marks, Second-Order Thinking. Howard Marks emphasizes second-order thinking, which involves looking beyond the obvious first-order effects and asking what will happen next after everyone reacts. In periods of market euphoria, like the dot-com bubble, first-order thinkers chase high growth, while second-order thinkers anticipate market psychology, overvaluation, and potential downside. Mark's approach teaches investors to consider not just the immediate outcome, but the consequences of widespread behavior, which allows for better decision-making under uncertainty. A historical analogy is Levi Strauss, who identified the unmet need for durable pants among gold prospectors rather than chasing gold itself, creating a business that lasted over 170 years. The lesson is to always ask what happens after the obvious and use that to guide your investment decisions. If you want to grow as an investor, these lessons from Buffett, Graham, Lynch, Fisher, Templeton, Neff, and Marks are timeless tools that can improve both your decision-making and your results. Start applying them today by focusing on trust and integrity, understanding qualitative factors, observing the world around you, digging for non-obvious information, and thinking several steps ahead. If you enjoyed this breakdown and want more content that simplifies investing and teaches actionable strategies, hit the subscribe button and turn on notifications so you never miss a lesson. Also, check the description for links to recommended resources and podcasts that dive even deeper into individual investors and their strategies. Join the conversation in the comments and share which lesson you found most powerful.